And you think about it like owning a business where the priority, as you mentioned, these metrics, the priority is, hey, what kind of cash flow will this produce me in terms of dividends? And in my case, option premiums.
Welcome, everybody. This is Bach Jarvi with the Wealth Formula Podcast, coming to you from Montecito, California. And before I begin today, I want to remind you there is a website associated with this podcast called wealthformula.com. Go there, check out the various resources, including if you're interested in joining our accredited investor club, you can do it there. It is exactly what it sounds like. It's essentially a group of accredited investors. You have to get onboarded, and it gives you the opportunity to see private deal flow that you might not see otherwise because they are not advertised. Anyway, go ahead and check it out, wealthformula.com. And again, that is Investor Club. Now, the other thing, in case you haven't noticed, is we are opening the door to something called Wealth Formula Network, which, door was closed on that for a long time. We were basically starting a new group there. It's a sort of a mastermind type thing. If you go to wealthformularoadmap.com, you can check that out. It used to be the case that this was part of a course. Now the course is being given out for free. So even if you don't want to join this group, feel free to go to wealthformularoadmap.com and pick up that course, which has got some very smart people on it, like Tom Wheelwright and Ken McElroy and such. And if you would like to join a group of individuals of like mind, it's a subscription basis. Right now, it's first month is free to give it a try for yourself. Go to wealthformularoadmap.com. Would love to see you on there. I think the next discussion we're going to have is going to be a deep dive on what everybody's doing for estate planning. So these kinds of questions are important. They're not things that you're necessarily going to talk to with your neighbors, your wife, your friends. So that's what we're here for. Okay, so let's talk about today's show. And you know what's funny? Going back, and I've been doing this show for a long time. I'm like definitely been around as long as just about anybody else in this alternative investment space. And I spent many of those years disparaging Wall Street very much. The idea of relying, solely on the stock market as a way to achieve wealth. I will say that over the years, particularly in the last couple of years, I've become not quite so dogmatic about my negative views on the equity markets anymore. I still believe, I will say, that building life-changing wealth, it has to involve more than stocks, bonds, and mutual funds, namely real estate, private businesses, gosh, even Bitcoin, stuff like that, right? This is where, if you want to take the next step in your personal financial journey, I believe that's where you need to be. Now, these things these are not risk-free things either, but I will tell you that, if you look across the board on, billionaires and, centimillionaires and stuff like that, they didn't do it just by investing, in stocks, bonds, and mutual funds. They had all these other things going on. I'm not saying you're trying to become a centimillionaire or a billionaire, but what I'm pointing out is that wealth creation has an important element of, you got to have some alpha there. And that's where a lot of these alternatives really, what they create. Now, that being said, I do believe, again, and different from before, that there is a role for stocks in my portfolio these days. That was something I would have not said 10 years ago. But I'm not thinking about stocks the way most people do, right? I think about them more like Andy Tanner, who is Robert Kiyosaki's rich dad advisor on stocks, and a guy we're going to talk to today. Andy approaches stocks as cash flowing assets and looks at stocks the way real estate investors would. And now this requires, I shouldn't say requires, but I think what he teaches has a lot to do with buying dividend stocks, for example, and then using a bunch of different options. If you've ever heard of, I'm sure you've heard of, things like selling covered puts and stuff like that. And that's what he does. So essentially what he's doing is it's a little bit more active, right? You get dividends paying stocks, and then you're essentially selling covered puts, and you're doing other option plays on those, and you are creating cash flow out of an asset that you own. Now, I have to say that, I never really tried this. So in the last 2 weeks, what I did, and I haven't taken Andy's course yet, I plan to, but, I did learn a little bit just about selling covered puts, and so he's picked out a few stocks that I was interested in, and I will point out that they were, stocks that are pretty volatile, like MicroStrategy. I'm interested in MicroStrategy because of my interest in Bitcoin. And then I tend to believe, I'm a believer that Tesla is grossly undervalued right now. I'm not, again, I don't follow stocks, but what I can say is they've got robo taxis coming out in the next, few years that are probably going to like completely change the way we live and, get from one place to another. And, you get these people burning Teslas and stuff like that right now. People tend to have a short-term memory when there's massive improvements in technology. Bottom line is, I think it's an interesting company that stock's getting battered. So I have been basically selling covered puts on these stocks. Basically, what that means is I have been essentially saying, I'll buy that stock. I'll buy that stock from you if it gets down to a certain point, and I put and I basically make money for making that promise. That's what essentially what a selling covered put is. So I got to tell even in the last 2 weeks, I've made about 4% on my money. Now, I hear I don't know. Listen, it may be completely beginner's luck. It may have something to do with selling options on stocks like the ones I mentioned that are very rich premiums or highly volatile, but so far so good. Now, do I believe I can achieve 80 to 90% annualized returns by this method? I doubt it. Especially once I actually, own some of the stocks I've been actually selling these options on just to try to own them. But I have been told by some people who follow Andy's method, which is apparently very, very conservative, and I guess what you'd say is pretty safe. It's not unusual for people in that to do what he's doing to be getting 25% annualized returns, if you're doing this for a bit. Anyway, that being said, like I said, I intend to sign up for his next Cashflow Academy course, and you'll get some emails from me on this because I know he's been, I'm getting them. I'm going to forward them to you. But the moral of the story here is that you can teach an old dog, which would be me, new tricks as long as the dog keeps an open mind, which I have, and I think I'm a lot more open-minded than I used to be on this stuff. But don't worry. I've not gone off the deep end. I'm still, ultimately a real estate guy. I'm a business guy, but I like the idea of keeping around some liquidity, which a lot of times in real estate I can't do. And this seems like a great way to do it. So I should also point out that if you've got a retirement account with, stocks and stuff, this is perfect for you. Like if you can do self-directed, this might be especially appealing. I don't actually have that myself. So I think you should think about it. Anyway, to understand why I've changed my tune on stocks with the likes of Andy Tanner's words, make sure to listen to this podcast interview with Andy when we come back from these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. As a result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Andy Tanner, and he is a globally recognized educator, investor, author, best known as maybe the founder of the Cashflow Academy, also as a rich dad advisor to Robert Kiyosaki for paper assets. He's taught hundreds of thousands of students worldwide how to generate real sustainable income from stocks, making complex strategies, investing strategies simple and actionable for everyone. He has a passion for helping people move beyond the traditional buy, hold, and pray approach to stocks. And he's the author of Stock Market Cash Flow and 401 Chaos with a K. And he's an architect. He's the architect behind Rich Dad's Stock Success System. Welcome to the show, Andy.
Mark, it's great to be with you again. It's been a little while, so I'm excited for our conversation.
Yeah, it's been a few years, actually. And got on my mind to talk to you in part because I feel like, we're seeing some opportunities in the stock market. Generally, I don't talk about stocks very much. And I think, it's a mistake to, admittedly, the more mature me doesn't necessarily rail against stocks under all circumstances, but looks at them as something that, you probably should have some exposure to. But, myself, quite frankly, I've been a real estate guy. I've been, in alternatives. I don't really understand stocks very well. So I thought, let's talk to Andy. Let's see what he's got. So thanks for joining us.
Well, I appreciate it.
Yeah. So when you talk about stock investing philosophies and foundations, you often emphasize the importance of a financial blueprint. So what are the key elements of a successful blueprint for stock-based income generation?
Yeah, and I think that blueprint works for any asset class, really. Stephen Covey said, "Begin with the end in mind." And one of the things I gave my kids when they were young is we played the cash flow game. It's a board game that Kim Kiyosaki and Robert Kiyosaki came up with. And the first thing you do when you play that game is you pick your dream. And you get crystal clear on what it is. So a blueprint should really be designed like a vehicle to take you from point A to point B. And so that starts with getting very clear on what point B looks like. What type of lifestyle do I want to live? How fast do I want to get there? And what's it going to cost me? And the moment you put a price tag on a lifestyle, it's no longer a dream. It becomes a project that you can work on. And whatever vehicles you want to use at that point, whether it be real estate, which I love, or stocks, which I love, or business, which I love, any of those can get you there. But that's where a blueprint begins, is determining where you want to go, how fast you want to get there, and what does that nut, that yearly nut to crack look like, and can I build passive income to cover that as opposed to working at a job? And that's the essence of a blueprint.
So when you start talking about buying stocks, how do you approach the process of identifying stocks that are maybe, they're best suited for consistent cash flow? Or do you just pick the stocks that you like and create the cash flow? Or are, fundamental metrics that maybe you prioritize?
Yeah, the first thing to determine, and I think real estate investors understand this, is if I were to invest in real estate, I'm going to determine whether I'm going to be a flipper, or I'm going to try and buy low, force appreciation, sell high, or if I'm going to be a cash flow investor where I might invest in syndication, or I'm going to have tenants in property management. And the same is true with stocks. Most people, and I think this is a mistake, most people start off by thinking about price rather than cash flow. They think about buy low, sell high like a house flipper. And that's less tenable in stocks, because in real estate, if I buy low and sell high, I can do things to force appreciation. I can renovate, I can get new management, I can put in new appliances. There's things I can do to force appreciation. But once a person buys a stock, there's absolutely nothing you can do to make the stock price go up. So I really don't like stocks as a buy low, sell high proposition. I get a little tired, but I'm used to it, where people say, Andy, where do you think NVIDIA is going to go? Or where do you think gold's going to go? Or where do you, but if you take if you think of it like a real estate investor, and you think about it like owning a business, where the priority, as you mentioned, these metrics, the priority is, hey, what kind of cash flow will this produce me in terms of dividends? And in my case, option premiums. And so some of the key metrics is, if I'm basically buying a financial statement, same as real estate, it's just a little different numbers. In real estate, I want to know what the net operating income is. And in stocks, I might want to know what the EBITDA is, because they're essentially looking at the same types of things. In real estate, I want to know what the cap rate is. In stocks, I want to know what the PE ratio is, which is just the same number inverted. They just put the price on the top instead of the bottom. So it's actually, it is, to me, I don't see a difference between real estate and stocks, in that they're both a business where they charge someone for a good or a service, and there's either cash flow there at the end of it or not. And if people take a cash flow approach, they can begin to build on their passive income, and that contributes to that blueprint we mentioned earlier to get them out of the rat race.
When you talk about cash flow in the context of these businesses, though, are you talking about it as distributed dividends, or what the business is making for itself, or,
Both.
Mm-hmm.
I very much care. If you take a Warren Buffett approach, who I think he's tough to argue with, he's done
Yeah,
pretty
of course.
well.
Yeah.
So if you take a Warren Buffett approach, the most important number in that business is operational cash flow or earnings, meaning does what they do, their operation, you walk in there, a nice operation you got going here, trucks are moving, and, products are being built and shipped, and nice operation. If they're earning money, that means that's the lifeblood of the business. That means it's got a good moat. That means it's pretty protected. And that allows them to do two things for me. Number one is a dividend, which is exactly the same thing as a distribution in real estate. There is no difference. In a syndication, I have a whole bunch of investors I've joined with where you have a share of this project. And when the earnings come out, they distribute the distributions among the shareholders. Same is true with stocks. They take the earnings, we call it a payout ratio, and they take a significant amount of that money and they pay it in a dividend, same as a distribution. But what I do that's a little bit unique, Buck, is I also have the options market on my side, where I can use options to control risk, to get guarantees where I can buy and sell. But even more importantly, I can offer and get paid for making promises to people. This is very much a Warren Buffett deal, where it brings a significant increase to my monthly cash flow beyond the dividend, up to 2 and 3 times the amount of money, 200 to 300% more cash flow by being involved in the options market. And that's a nice secret sauce.
So let's just, just for the sake of making sure people who are not familiar, so far, I think what I've gotten from you is, the way you choose stocks is similar to buying any quality asset. You want to make
Correct.
sure that, you may or may not, and we can talk about this in a second, choose stocks that are paying dividends, but you want to make sure that, these are cash flowing companies, that they're underlying healthy companies. I guess the analogy would be, you don't want to have, you don't want to be in a syndication where they're distributing cash necessarily, but the business itself is, or the property itself is not generating income. That doesn't make sense. So that's that. We've got that type of income. Now you're talking about options, and for those who are not familiar necessarily with options, you use this approach in what you call income stacking, right?
Yeah.
Where you. And so what, in the big picture, what are options?
Well, an option is a fancy word for choice. It means I can do something or not. I have a choice, an option, same word. And in the options market, what investors do is they often want guarantees. So let's say, for example, that I'm Farmer Joe, and you own cornflakes. And I want to sell you my corn, and you want to buy my corn. You would really like to have some stability to know what price you can get for my corn. And I would really like some stability to know what I could sell. So you might buy an option from me. You might say, Andy, I'll pay you some money right now if you'll promise to sell your corn for me at this price down here. And I can look at that and say, yeah, I'd be willing to do that. And so that would be an additional income to me, the farmer, for making a promise to sell you my corn at a certain price. And that's really what an option is. So Warren Buffett does this all the time. There was a railroad called Burlington Northern Santa Fe. It was trading about $85 a share. And some fund manager is nervous. He bought it at 80 and he's nervous it'll go below 80. If it goes below 75, 70, he's really going to get fired. So Warren Buffett will go to him and say, hey, look, I'll tell you what, I'll make you a promise that gives you the option or the choice to sell me your stock if it goes down to 75. That way you've got an insurance policy. It goes to 70, 60, 50. I'll still give you that 75. You can sleep at night, but you're going to have to give me a few bucks a share. And that's called a premium. So it's very much like insurance premium. Well, essentially what I think is interesting, Buck, is people in 401ks are doing this anyway. If you're in a 401k, you basically are signed up to take a portion of your check next month and buy some stocks, in a mutual fund, buy some assets. But you get zero money for that promise. So, and you're also going to pay the highest price. No matter what the stock market's at, you're going to pay the highest price. But you are making that commitment. Professional investors, people like Warren Buffett, and I follow this, is I'm going to get paid for that promise. If I'm going to guarantee you that I'm going to buy something from you in advance, that time is worth some money. And I'm certainly going to collect that. And it essentially reverses the cash flow pattern of a 401k from one that pays fees to Wall Street that's going to collect fees from Wall Street. And it's very conservative, can be done in an IRA, and that stacks that income. So I have a baseline of a dividend I get, and then on top of that, I get my option premium. And then on top of that, I get any appreciation if the stock does go up. So it's very nice to be able to make money the same way I make money in my real estate. I get these, Zillow will send me these updates on the properties I have. And it's hilarious just to say, oh, your property went up X amount, or your property went down X amount, or up or down. And I really don't care about the price of that property because I have no intention of selling, because why would I sell the goose that lays the golden eggs? It's the rent that I want to make sure is maintained. And in stocks, it's my dividend and my option premiums that I want to make sure are maintained. And those option premiums come no matter what the price is. So it's a great system. It's a lot of fun.
So we could talk about a couple of interesting strategies just as an example. I mean, maybe let's talk about, just some terminology with calls and puts that you give some people some ideas, like how, once you have that portfolio, how you can potentially start generating income. Would you just give us maybe an example or two of that?
You bet. Let's talk about it. I love that you're willing to dive into a little jargon, so that's great.
Well, we want to get people to sort of visualize this, right?
Yeah.
Instead of just theoretical.
So I'll give you an example. In COVID, one of the nice stocks I picked up. So in COVID, people stopped traveling. There weren't planes, trains, and automobiles moving. And as a result, we stopped using oil, and oil plummeted. The price of oil went negative for a while. There was so much oil that they had nowhere to put it, and they would actually pay people to take it off their hands if they had a storage tank for delivery. So with this the stock price of ExxonMobil took a dive, and it got down into the into the low 30s, high 20s, low 30s. That's incredible. So I'm looking at this price, and I say to myself, oil's not going to be free forever, man. I'm telling you that. The virus isn't going to live forever. This is an opportunity. So the first thing I did is I looked at ExxonMobil's dividend history, and I found that they have raised their dividend for nearly 40 years in a row. That's back when I was in high school, man. Further, junior high. So here's a cash flow. Picture this as a real estate investor, that you're in a syndication where the distribution went up every single year for 40 years in a row. Never a miss one time. Never a missed dividend, and never a missed increase each year. And I'm looking at that. Today, it's about $4 a year. It's 99 cents a quarter. So it's about $4 a year. Back then, I want to say it was maybe 90 cents, something like that, whatever it was, 80, 87, whatever it was. So you're looking already that if you buy that, let's just say you buy it at 40, you're already looking at a 5 to 6% return just out of the dividend right there. So what I did is I said, you know what? I'll make a promise to buy this. And let's just, I bought, my cost base was a little bit below 40, but let's just call it 40 for sake of simplicity. I could actually promise someone to buy that stock at 40 that month, someone who's nervous that it'll go down further. Because I think to myself, that's a steal at $40. That's a steal. So they might pay me up to $3 or $4 just to do that for the month. Well, think about that annualized. That's 10% in 1 month, plus the dividends another 5 over the year. I'm at 15% day one before I even, bang, nothing. It was right there. And then once I own it, I might that's called a put option. So, I sold puts. I had cash in my account, and I made a promise that gave someone the choice, that's the name option, to sell me this stock at $40 if they wanted to. Now, if the stock were to go up, I'd keep the money. If the stock were to stay the same, I'd keep the money. If the stock goes to 40 or below, I get to pay that $40, and I keep the premium no matter what, up, down, or sideways. So this independence of price from price is incredible. People think, how can you make money up, down, or sideways? Well, the dividend makes me money up, down, or sideways, and the premium makes me money up, down, or sideways. Just the same way rent is the same regardless of the movement of the price of the home that month. The rent is by contract. Well, options are contracts. So it's pretty cool. Once I own the stock, what I do is I'll do a very basic strategy anyone can learn called a covered call strategy, where I'll sell someone the option to buy it for me high. So right now I haven't looked at it, but I'd say, Exxon's probably around $100 now, somewhere around in there. And I might say, hey, this month if it bumps to 130, I'll sell it to you. You want to pay that much for it? I'll sell it to you. And they're willing to do it because they don't want to cough up $100 to buy the stock to find out. They'd rather buy the option to buy that stock later. And so a person, if the average return in the market just by growth is 8 to 10%, well, that's fine. You're going to get that anyway just by participating. What I like is adding to that idea, the idea of a dividend income of 4 or 5%, and then stack a covered call or an option income of up to 12 to 15% a year. I don't think it's unrealistic. If someone came to me and said, Andy, I did 20% a year on my cash on cash investment, I'd say, yeah, it doesn't surprise me. Doesn't surprise me at all.
So that was the question I was going to ask you. Is I think a lot of this comes down to, well, this sounds really interesting, but what's realistic? So you say, and obviously I'm not asking you to project what everybody's going to make, but typically somebody who's engaged in this, it's not unrealistic. It's not, crazy to think you could do 20% cash on cash.
Yeah, I think the way I'd frame that, because you and I are always going to be cautious when we throw out numbers.
Yeah.
Is I don't frame it as the investment. I frame it as the investor.
Yeah.
It's kind of funny. Risk is really a function, I think, of who's doing the investing as opposed to the investment.
Sure. Mm-hmm.
If my mother were to try to do this, she would not get 20%.
Yeah.
She wouldn't, because she doesn't have the education.
Mm-hmm.
But if one of my teachers, Corey Halliday, said he did 25 to 30, I'd say, I wouldn't be surprised at that. So I think it's really a function of the investor rather than the investment. But even if we went conservatively, if your dividend has had a great dividend history and it's given you, 5, 6, 7, and you do a 0.5% a month for another 6, even a double-digit return is not out of the question, and not something would blow my hair back by even a newbie trying to do it. The key, though, is there's 4 things to learn. And I attract people that want to learn like you do, Buck. I think it's funny. People say, well, I don't want to have to learn anything, as if learning was a bad idea. Actually, if you're learning something that you like, money making, the learning's actually really fun to do. And so, I was on an airplane once and the guy said, "Oh, you're a stock guy, huh?" I says, "Oh, yeah, I guess." And he says, "You got any tips for me? Just give me some tips. I don't want to have to really learn it. Just tell me what to." That's kind of greedy. Like, give me free money, give me something for nothing. And so if a person doesn't like learning, they'll struggle in any investment. But if they love learning, they'll thrive, whether they choose real estate, stock. If the people listening get closer to their goals in the next 5 years, it's not going to be because of the asset class they chose. It's going to be because of the personal development that they engaged in that asset class, because I can find winners and losers in every asset class. So it isn't Robert Kiyosaki didn't become wealthy because of real estate. He became wealthy because of personal development. Warren Buffett did not become wealthy because of stocks. A lot of people buy stocks. He became wealthy because of personal development and education and discipline and that type of stuff.
Sure. What do you think are some of the most, for people who are starting out, some of the most successful ways to just kind of start doing this? And obviously, you have a course that we can talk about as well in that context. Maybe you could tell us a little bit about that.
The first thing I would do is consider opening a paper trade account to practice first. That's one advantage of stocks that no other asset class does as well. If you've seen Apollo 13, there's a scene where Gary Sinise is on the ground in a simulator, and he's simulating the limb, and he's doing a power-up sequence to test before they set it up to the real limb. So if you can get a paper trade account at your brokers, they all have these virtual, these fake accounts, real scenarios, real stocks, real prices, real option pricing, and you get a chance to get your feet wet with no risk. So I think that's a great way to start and find out. But what people will discover is fun. They'll realize, I didn't realize this was this simple. I thought I had to day trade and stare at my computer all day long. It's not like that at all. You're doing this once a month for maybe 15, 20 minutes is about how long I spend. Maybe 20 minutes to get all my options set up for the month. And so that'd be the first thing. And the second thing, if people want to learn, our courses are not like, going to law school. I had a relative went to law school. He wound up with $300,000 in student loans, in 8 years of working at this thing.
Mm-hmm.
It takes about 20 hours to go through my basic course on how to stack these incomes. It takes about 20 hours. And by the time someone's done with that, if they have a paper trade account, for much less than $300,000, they can learn how to do it.
So with your course, are you learning? Obviously, you're learning the techniques, the options, the dividends. Do you also kind of talk about choosing stocks, or I guess in some cases, just tell people why you think certain stocks are attractive for doing this kind of thing. If you're interested, how does it work? And is there anything ongoing with that, community wise?
There is. Yeah, there is. We've invest same as real estate. You invest based on criteria. So for example, one of the most important things I think in my criteria for real estate is population growth. Are they building a factory that's going to bring in workers? Do I see a trend of more and more population, which will create demand for housing? So for me, that would be a criteria. That box has to be checked for me to say, yeah, I want to be part of this syndication or buy real estate in that area. Well, the stocks are the same thing. And there's 4 pillars of investing I speak of. The first one's called fundamentals, where there are just certain fundamental things. Like I mentioned, real estate, you would want to have population growth. That's just fundamental, right? That's a must. That's a box that got to be checked. So what I do is I take in fact, I even use some of the reports from the syndications I'm in, and I put them side by side to what we call an SEC report for stocks, and people are blown away that they're the same. They're just called different things, different names for different numbers. And I take them side by side so someone can learn how to look at a real estate deal side by side and look at a stock deal and say, does this check the boxes? So yeah, we do it. We choose stocks based on criteria. And what's cool is we can run searches, and AI is fabulous for this, is we can run searches to say, go find me the stocks that fit this certain criteria that I'm interested in. And then day one, I'm making money because remember, what can I do? I can say, I like that one. Here's the price here. I promise to buy it cheaper. And I can get paid up front, click and get paid to make a promise to buy it if it goes on sale. So I can actually make money on my cash without even buying things. You can make tremendous returns just by promising to buy things if they go on sale. And with all the tariffs and all the stuff and the volatility right now, options premiums are the best they've been since COVID. I mean, it's such a great time. The volatility helps option sellers like me. It's a gift. I mean, it is. I was on a podcast a while back. Someone said, what do you think of all this tariff stuff? I said, well, I don't need to know much about the strategy or what they're doing just to know that it's glorious in terms of premiums. It's fabulous.
Yeah.
It's
and
great.
And then there's also a community involved with that as well.
Yeah, it's kind of fun. We have another thing we do is we have something we call our mentor club. It's pretty exclusive though, but if someone wants to get really serious, every Monday we have a portfolio we trade. And just every Monday, once a week, we record what we do. And we take those 4 pillars I mentioned, fundamentals, technicals, cash flow, risk management, and we apply them in real life every week. So people can follow along and they can open up a pay-per-trade account and practice right along with us with our portfolio and start just click what buttons I click. And it's almost like learning a language by going to the country. You're immersed in this. And so that's a fun community of people. And we send that video out every week. And so people can actually copy us and learn by doing what we do. And when we make money, they see it. When we lose money, they see it. And there's, it's just, we've been doing it for 12 years. So it's fun.
Have you kept a track record of how that's done over the last?
Yeah, my compliance officer says I'm not allowed to say what that is because they say, well, then people are going to expect that. But I will tell you this. The people that have been with us have been very happy. I think I'll leave it at that.
Yeah. Just so people know, and I'm asking a lot of these questions in part because frankly, I'm potentially interested in this as well. Andy's known to be a great educator. He's obviously a good guy. And so I'm seriously considering doing this myself. And so if people want, I have in the email that I send out every week for this podcast, there's a link. You can check up. Andy has an event coming up, and that same link will also be if you're watching this on YouTube, it's down below. If you're watching this on a podcast or listening to this on a podcast, it'll be in the information below. But Andy, tell us about what you're going to do there.
Yeah, we've got some fun things for people. The first thing we have with that link I'll give you is we have a free, you mentioned a blueprint. We have a free ebook with that, and it helps people learn how to build that blueprint. We call it the Rat Race Escape Plan. And so they can get that. And then we also have webinars people can attend for free that go into greater detail and give examples of the things we've discussed. So they can learn a lot about that. And that stuff's all free. We do that as a way to have people learn about what we are and, see if they want to take another step and get a little more serious about their financial education area. I think it's a great time because I think we're going to see a lot of boom and bust. This is very reminiscent of the .com era, where you saw a lot of potential with the internet, but you didn't know the FANG trade, the Facebook, Apple, Netflix, Google trade. You didn't know who was going to sell as the winners. The reason I like stocks right now as much as real estate or anything else is because of AI. If you think about production and our country's gross domestic product, how do we produce? Certainly AI will be replacing some jobs, but I think more importantly, I'd rather have an employee do 10 times the productivity than just get rid of them and replace it with an AI. And if they can use the AI to be more productive, So it's not going to be about NVIDIA or Apple or Google because they'll be the leaders in the AI technology. What it's going to be is everybody. Your business is going to get better because of AI. The guy who sells paper clips, the guy who sells ketchup, the guy who pumps gas, every business is going to become more efficient, more productive, and more profitable because of AI. Over the next 10 years, it's going to be really fun. We're going to see some volatility with speculation and tariffs and a lot of craziness going on. There's a lot of pressure systemically with our federal government doing some weird stuff that will give us huge opportunities to buy low, huge sales when stocks fall. But at the end of the day, the reason the market always recovers is people need food, clothing, shelter, medicine, communications, and energy and banking. And those are the industries that are necessary for a growing population. And so they will do very, very well. So if you and I learn these things now, and we learn how to make money on the way down, and we learn how to seize these opportunities, I don't give guarantees very often, but I would bet every dollar in my wallet that 6 or 7 years from now, we'll replay this very podcast and people will say, man, I wish I would have gotten involved when those fell, because the upside of AI in business is a bigger upside than anything I see in any other asset class right now. It's bigger in gold, it's bigger than any other asset class because there's no ceiling to the efficiency of what AI can do for a company. So I think it's a great time to get involved.
Yeah, I just say too, for me personally, I think I have for years really not been interested in stocks. I've been, sort of like the idea of these what we call real assets, things, tangible stuff.
Yeah.
But what I do like about your approach is it's not passive. You're actually doing something to generate income with assets that you own, which is a completely different concept.
Yes.
And if you're really thinking about cash flow in particular, which I think a lot of people are, it's like, we do a lot of value add real estate and all that kind of stuff. And maybe we get a little bit of cash flow, but in reality, a lot of times the truth with real estate is a lot of it still is an appreciation play. There's no real estate you're buying right now that's going to give you, 15 to 20% cash on cash. It's just not reality. I mean, and so
I love the real estate. I think it's a little tougher environment right now. There's times where you can really clean up. Like 2008, when everything collapses, that's when you seize everything, right? Is in a collapse.
Yeah.
But I'll tell you, the thing I love about real estate, Buck, is, I understand short positions as a stock guy.
Yeah.
And really what real estate is, if you're using debt to get your real estate, I think it's one of the best moves. And here's why. You're shorting the dollar. Warren Buffett talks a lot about this. I can't tell you where Apple's going to be next year, but I'll tell you what, in 30 years, there is no call I can make with more confidence than saying the dollar is going to be less value in 30 years than it is today. And by borrowing that money when it's fat and juicy, and then repaying it back to the bank over 30 years as those dollars lose value, you're actually in a short position on the dollar as much as a long position on real estate. So I love real estate for that reason. I just think
and don't get me wrong, I'm still a real estate guy, but I just think I'm a lot more open to this idea the way you deliver it, because it's not, it's a means of creating cash flow. Like it's an active cash flow concept rather than just buying hope, which is, I think, what a lot of people are frustrated with when they think about stocks. It's like somebody else's game,
I have that same frustration because if you and I are to look at CNBC today and turn it on, it'd all be about buy low, sell high. It'd be what are the big winners? It's price. They don't approach it as a business. I'd like to speak to something you said about tangible asset. I think one of the biggest boats people miss is the idea that stocks are not a tangible asset. For example, if I was giving a speech one time, and I had a lot of fun with this. I set it up before so I'd be okay, but it was a gold play, so everyone was talking about gold and real estate. See, touch, and feel. And I set this up before, but someone was saying, stocks weren't real. So I asked this guy if I could hold his iPhone for a minute. And he said, sure. And I threw it in a pitcher of water. Now, we'd set this up before. It was kind of a fake thing. But everyone just gasped. And I said, what are you worried about? It's not real. This isn't real. It's not tangible. This isn't real technology. In fact, you don't even need to pay your bill because it's not a real service. Their IP isn't real. Their factory isn't real. It's all just paper. In fact, when you're talking on this thing, it's an illusion. It's just paper. The fact of the matter is, a deed is a piece of paper that represents ownership of something real. A stock certificate is a certificate of something real. The only thing that's not real and backed by something is the Federal Reserve notes that we're trying to get, which aren't backed by anything.
Mm-hmm. Yeah.
So there's tremendous value why Warren Buffett looks at this as farmland. Think of it like this in terms of a tangible asset. This might help. I don't like selling real estate at all, ever. And the reason is, once I can secure an acre on this world, there's a limited amount of acres. And the game is like Monopoly. If I land on it, I buy it. I want the most acres, and I want to share my share of the land in this world, right? That's it. Now, picture the gross domestic product. Picture a machine that generates insane cash, production, medicine, communication, energy, housing, lumber. Take Burlington, Northern Santa Fe. If you want to build a house, then you have to use my railroad to get the lumber, the steel, the plastic, and everything else. You have to use my railroad. And so think of buying a share of the S&P 500 as getting some of those limited shares of production of that machine. To me, it's very much like real estate. I just land on it and buy it. I want my share of that production.
I want to ask you a little bit about some of these. There are some stocks that you can buy, and I'm just curious on your thoughts, that sort of do automatic option plays. And the one, like, for example, this one I looked up, it's the Yield Max Tesla option income ETF, which is TSLY. And basically what it does is it just does a series of longs and shorts and then generates what looks like to be kind of a ridiculous amount of a dividend per month. So what are we missing here? What's
Well, you're basically hiring those guys to mow your grass. They're absolutely doing something that you could. It's just like any other mutual fund or any other fund. They're doing something that you could absolutely do by yourself and not pay them a fee. And that's there's two cultures. There's the advice culture and there's the education culture. And the advice culture, people say, look, I don't want to learn anything. Just give me the advice. Well, you'll pay for that in fees. And
Sure.
the problem with doing that is, if you really listen to Warren Buffett, he'll say 1%, here's his words, 1% is enormous. Because in the wealth blueprint that we do for people, we use compounding. We use the compounding calculator to see what we're going to need. You drop that 1%, you give up 1% of your compounding power as an investor over your life, it wouldn't seem like 1%, but Buffett knows the truth. It's enormous. So yeah, absolutely. There are ETFs and there are funds that will do exactly what I do or what I teach people to do. But we have some advantages in doing it yourself, because risk is about control. And I trust myself more than I trust those guys any day of the week. And like I say, I'm doing this by month. So yeah, but it's legit.
Yeah, and there's also the big difference is you're not just going into one stock, right? I mean, it like, for example, these like this one for Tesla, all it's doing is trading Tesla's volatility and options.
That's correct.
You're not. So you have the additional.
You're never really going to own anything solid though with that.
You
right?
don't own Tesla, period. In fact,
Correct.
you miss all of the alpha potential on Tesla.
Yes.
And also you're just dealing with one stock. So all of a sudden, for some reason, Tesla becomes not volatile. that stock's going to go down the drain. So what you're teaching is sort of, with multiple stocks, potentially a portfolio that you already own and that you can kind of, have as you own this, and how can I take what I have now acquired, or maybe I already have, and make money out of it? That's kind of a big.
You're nailing it, because we use cash flow to acquire more asset. That's what compounding is. Compounding essentially means reinvestment. So if I'm buying low and selling high, buying low and selling high, my asset is leaving my asset column and coming in and out. We're not about that. We're about get paid to buy the asset. When the asset creates cash, go buy more asset and build your kingdom. Same as real estate. I want as many doors as I can get. I want as many shares as I can get as I go through this process. So yeah, you're right on. And one of the things you mentioned about Tesla is nice. Tesla doesn't pay a dividend because they're a growth stock, and that's okay. Because, even before Tesla was profitable, the reason the stock went so high before they turned a profit was people knew it was just a matter of time. The direction was headed the right way. But on those stocks, the premiums are so high, as you mentioned with this fund you're talking about, the premiums are so high that the cash flow that can be generated on the way to getting a dividend someday, Apple didn't pay a dividend for years. And finally, when they started, paying, when Buffett bought Apple, but you could make just as much money in cash flow by using options on these. And what we're doing is we're not betting on a direction, we're betting on a range, which is much easier to do. I could show you on my Galton board. This is a Galton board. It's a probability calculator. And no matter how many times I randomize the grains of these little BBs in here, it's going to come out to the same ratios and distributions every single time. That's predictable outcome, high probability. So the options market isn't based on guessing direction. It's based on a range. So example, I could bet that Apple won't be zero tomorrow and it won't double in price. That's a 100% range, though I'm nailing that. Well, I can also see this. Apple's not going to get it 10.5 tomorrow, and it's not going up 50%. That's also a very unlikely range. So as I learn how to play at these ranges that are statistical certainties, you become more like a casino rather than a gambler, where you're simply going to use mathematical probabilities to generate your income, as opposed to hope for the anomaly as the gambler does.
Right. Interesting stuff. Andy, am I missing anything? We kind of cover everything.
You're nailing it. No, you're nailing this.
Okay.
And it excites me, because once a person understands it all spends the same, and you're really buying a business, it really doesn't matter whether the business provides housing or provides electricity or provides gasoline or provides communications for people. The more, here's a rich dad ism, what Robert Kiyosaki, I don't want to put words in his mouth, but I think you would say this is a generalized principle. The more people that I serve, the more effective I become. And stock ownership gives me the chance to serve the world and to be an owner of a company that serves the globe.
Let me ask you one question before we go out that just occurred to me. Some people are thinking, I don't know if I have time for all this. Like, how much time does it take a typical person once they learn this? I'm not talking about the 20 hours to learn this, but like, is this not a full-time job, right?
No, you can do as much of this as you want. I don't prefer day trading. I look at that as another job. Now, some guys love it and some guys get really good at it. For me, I write my options 4 to 6 weeks, generally. And so there's an expiration every third Friday of the month. They expire. That's the standard expiration. And so on that Monday, that next Monday, I will do another round of options. And that takes me about 20 minutes to go through. Incidentally, speaking of time, my sons, when they went from 8th to 9th grade, I pull them out of school and we do what's called a gap year. We do 1 year financial education at home, one-on-one with dad and mom.
Wow.
And, today my older son is a senior, and he's been doing this while going to school, while playing basketball, while doing all the stuff he does. He's been doing this now for 4 years on his own. So I'm a proud dad that way. And,
Yeah.
and if my kid can do it, both my sons, if they can do it, anybody can do it. So no, this is not, I liked what you said though. There is an intensity of time in the learning phase like anything else. There's about 20 hours to put in to learn it. But once you learn it, if you're spending an hour a day on this, you're spending way too much. You're checking this about less than you would check your email. Less than you would check your email.
Well, great. Andy, I appreciate all your time and knowledge here. And I'm sure people are going to be interested in learning more about Cashflow Academy. Again, use the link. You can get it at the email I sent out, or if you're watching this on YouTube or in the podcast, just look in the information below and you will find it. Andy, thanks so much, and we'd love to have you on again sometime.
Buck, it's always so good to be with you, and I'm excited to do anything I can to serve those that follow what you do, because you and I are in the same boat. We care about financial education, and it improves people's lives. It elevates their well-being, and that's what we're both about.
We'll be right back. You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s, and now you're trying to catch up. Meanwhile, you've got a mortgage or private school to pay for, and you feel like you're getting further and further behind. Now, good news, if you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator, and it can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com.
Okay, welcome back to the show, everyone. Hope you enjoyed it. Like I said, I'm up 4% in less than 2 weeks. This could be good. It could be good. Anyway, sort of halfway joking there. I am kind of excited about it, honestly. Could be, I like learning about stuff. And if this is a way to just have one more source of income or a stream or something like that, then I'm all for it. And again, like I said, I am personally going to sign up for Andy's Cashflow Academy. And so hopefully if you are doing so as well, I will see you in there. I don't know how it works, but if you get to know who else is taking it, I will be there. Okay, that's it for this week on Wealth Formula Podcast. This is Buck Joffrey signing on. If you want to learn more, you can now get free access to our in-depth personal finance course featuring industry leaders like Tom Millwright and Ken McElroy. Visit wealthformularoadmap.com.